Welcome people, my name is Sean, and in this video we're going to explore the differences between investing and trading. So what is an investment? An investment is basically putting your money into something and over a period of time you expect a return. For the purpose of this video, we're talking about stocks. So you put your money into stocks and over a period of time you expect a return from that money that you put in the stocks. So now that we've covered what is an investment, let's talk about what is a trade. A trade is basically the active buying and selling of a share or stock. Remember in my previous video, I mentioned that stocks and shares are the same thing. They could be used interchangeably. Let's not get caught up in technical definition. So trading is when you buy or sell a stock. Okay? So investment is when you put your money into something, which is a stock in our case, and you expect a return over a certain period of time. And trading is the active. I want you to pay attention to the word active right there. The active buying and selling of a stock. Now, you might say they're the same thing, which to some degree you're right, but there is a difference. And we're going to explore that fully in this video. The main difference between trading and investing is time. Time is the construct that affects what you call a trade from an investment. So let's start with investment. The average investor usually holds their stocks for more than 1 year. So they buy a couple of stocks, right? Because they want to have a diverse portfolio. And they hold their stocks for like 2 years, 3 years. Some people hold their stocks for like 5 years. Now this strategy is called buy and hold, right? So you buy the stock, you don't sell it 3 months, 1 year later. You sell the stock like probably 5-10 years later. And it's not as volatile. You're less likely to lose your money if you do that, because the longer time you spend holding a stock is the less volatile that stock is. Because usually stocks are uptrending over a period of time. That's the usual case. Business do well, and because business do well, the stock price increase in value. So long-term investors usually get the full benefit of stocks because they hold their stocks for a period of time, then they sell it. Investors are usually thinking about the long game. They don't really care about the short-term results. They want to know if the company is profitable and it has longevity and sustainability. And those are the companies that investors go after. So that's what you call an investment. They invest in a stock. They are not trading, they're investing because they hold it for more than 1 year. Now let me make this clear. There's no solid definition of how long you got to hold a stock to consider it an investment. I'm giving you a reasonable time frame based on my experience and what I've read and what I've learned and what I know for a fact how the market operates. Usually when people hold a stock for more than 1 year, it's called an investment. So let's just go with that because you're just starting out learning how this thing works. So just get in your head. Let's not get technical. Investment is when you buy stocks and hold it for more than 1 year. So let me give you a quick example of an investor. Let's say I have $5,000 and I would like to purchase a house 5 years from now. I'm going to invest in a couple of stocks because remember from my last video, how you mitigate risk is to never put your eggs in one basket. So I have to buy a couple of stocks in order to lower my risk. Okay, so with that being said, I need the proper stocks to choose. In another video, I'll show you exactly how to go about doing the analysis to choose these stocks. But I'm going to give you a quick crash course. You look around, you see what's popular right now, and you do some research to see what's going to be, sustainable. So you look at phones. Everyone communicates with phones, and the two biggest competitors right now in the phone industry is Samsung and Apple, right? So you say, all right, you want those two stocks. Then who usually delivers phone if you order it online? Amazon, right? People use Amazon a lot. So you say, all right, I got two of the biggest phone competitors, and I got the delivery man for them, Amazon, right? So that's 3 stocks. You need 2 more stocks. You got $5,000. You're going to engage in fractional trading for these stocks because you can't afford the stocks outright. Amazon is like $3,000 right now. So you only have $5,000, and you want to split your stocks evenly across the board. So you put 1,000 in Samsung, 1,000 in Apple, 1,000 in Amazon, right? We need 2 more stocks. Think of clothes, the clothes you wear. Adidas, they're not going out of business soon. Put 1,000 in Adidas. Nike is not going out of business soon either. They're rival to Adidas, and it's good to buy rival stocks. So you got 5 stocks. You got Samsung, Apple, Adidas, Nike, and Amazon, right? You put 1,000 each in them on Cash App. You're going to keep that for 5 years. Now, the rate of growth usually, and I say usually, take it with a grain of salt, things could happen. But as we could see last year during the pandemic, these stocks that I just listed, they grew. They still made money, right? And they didn't go out of business, and it was a pandemic. So that is to show you the credibility of these stocks. So that's a quick crash course I just give you. I'm going to have videos going in depth of how you do this. Okay? So just for now, the crash course will work. So just to continue what I was saying before, the rate of growth for investing in stocks is usually 10%. Now, some stocks, they grow a lot more than some. Some stocks grows 40%, 50%. If you get some beginning stocks, they just had their IPOs and you get it good, you could have probably upwards of 50% rate of growth. But not to get too excited, the average rate of growth is usually 10%. So if you invest in Samsung, Adidas, Apple, Nike, and Samsung, Adidas, Apple, Nike, and I had one more, Amazon, right? If you invest in these 5 stocks today, 5 years from now, according to the historical records of the stock market, you'll be sure to be sitting on at least $8,000 5 years from now. At least $8,000. It could be 12, it could be $15,000, but I don't want to get you too excited and sell you a highfalutin dream, so I'm gonna be real. It could be $8,000. It could also be less than $5,000 what you invested. It could be $3,000. That's a downside to it. Things could happen. One stock could go crazy, another stock is doing poor, 2 stocks could be doing well, and those are the 2 stocks that let you keep your money. So it could go both ways, but the trajectory of stocks going down, especially for big firms like that, is minimal. The probability of it happening is minimal as well, and you're investing, so it's your cash money. You didn't borrow money to do that. So the likelihood of that happening is small, but it could happen. But to the brighter side, what usually happens is that your money will grow at least 10% per year. So that is investing. Now, trading is a different thing. Traders usually stay in the market for like a couple minutes, or they stay for the day, and you got some traders who stay for weeks. So the traders who enter the market and they buy and sell shares within minutes, then leave the market. They make their profit, leave the market. Those traders are called scalpers. You got other traders now who trade for the entire day. So they go in the market, they see a couple trades, they see stocks that they want to trade, they trade them for the day, and at the end of the day, they close the trade and make profit from what they sell or buy. And that's called day traders. Now you got this other set called swing traders who stay in the market for weeks. I'm going to try to clarify trading in its simplest form. I'm going to give you an example. Now, there are different types of trading. And we're not going to get into that for this video because we have other videos to come that's going to explain these stuff in depth. So, let's say I'm doing something called options trading on Robinhood. Only some platforms could do options trading. And this is where you buy a contract stating that you have the right to buy or sell a couple of shares at a certain time. That's all. Don't worry yourself about it. Usually this is leveraged trading as well, meaning the broker lends you money. The platform that you're trading on, they lend you money. So for Robinhood, you have to have at least $2,000 and they would match that $2,000, lend you $2,000, so you have $4,000 buying power. Now, in trading, if you're going to do a one-day options contract, that means you're going to buy 100 stock per contract. One option is 100 stock, right? Follow me. And then at the end of the day, if you buy a call or a put option, whatever it is, if it works in your favor, you make profits. If it doesn't work in your favor, you lose money, and sometimes you end up owing the broker money. So I know that's a bit complicated for you right now, but you'll understand eventually in the other videos to come to explain options contract. So now I'm sure you could see things from a different perspective in regards to what is an investor versus a trader. So investing is buying and holding stocks for a duration of more than 1 year. And then traders, on the other hand, is buying and selling stocks and shares less than a year, down to the very minutes of a day. So you could tell by now that trading is a lot more volatile than investing. Trading is a good way to lose your money if done incorrectly. All your money. You could blow your account within less than 5 minutes. You could blow $10,000 in 1 hour or less. I've heard many stories of that. You could also gain 100K in 2 hours if you know what to do and if you apply the necessary knowledge and tactics. Right. So investing is definitely a more secure and reliable form of making money. Trading is a faster way of making money, but unfortunately, it's the fastest way of losing money as well. So let's do a quick little recap before this video ends. Investment is putting money into a stock and expecting returns. Now, the investment part of it is the longer term, which is more than 1 year, you expect to get a return. And the trading, which is the active buying and selling of the share, you're looking forward to get return off your trading within less than a year. That is it. So investment is more than a year and trading is less than a year. That's when you're looking to get your return. Time is a construct that differentiates investing from trading. Please remember to subscribe, like, and comment. Share the knowledge. Share this with someone who is confused about what's going on in the stock market. And stay tuned for more videos. I'm coming out with 2 more videos next week. And I'll be going in depth on how to go about getting the right stocks and I'll explain different types of investors and traders. Thank you.